Welcome to Compound Insights, CFA Society New York's podcast. I'm your host, Rob Rowan. We're here to talk about how one large investment manager has integrated ESG issues into their analysis. I think this is important to hear because ESG integration is tricky and their preparation for it was substantial. On this topic, we will hear from Jessica Ground, Schroders Global Head of Stewardship, and she is chair of Schroders Corporate Governance Committee. She is responsible for the firm's sustainability strategy and global corporate governance. She oversees the integration of ESG factors into the investment process across geographies and asset classes. Earlier, she was an institutional fund manager and a pan-European financials and utilities analyst. So I would like to begin talking with you about the background thesis. I thought it was really interesting because the depth of the research you did into it. Particularly, I'm interested in your perspective on how the impact of the growth of the largest companies in the universe is impacting the ESG efforts and their declining ability to offload the social and environmental changes onto the public sector.
Great. Yes. So one of the things that we've noticed, and you can see, is that over time, companies have become a larger and larger share of GDP. That's not only because of a rise of the superstar firms that we're all familiar with, but also if you think globally, trends towards privatization have also had quite a big role on this. At the same time that this has been happening, I'm sure all of us are aware of the facts that governments have got less and less money to spend on. So our central thesis is that governments are going to be looking to corporates more and more to support their desired outcomes that they want to have. And we've already started seeing this if you think about our everyday lives. We're sitting here in New York, you've had sugar taxes to sort of combat obesity epidemics. There are carbon prices over 25% of emissions globally. And really topically, we've also seen the farmer pressure coming under a lot of pressure for drug pricing. Right. So even in the most free market worlds, we're seeing some unfree market activity, which is definitely meaning that ESG issues are being monetized much faster than before.
Mm-hmm. And now the other part that you observed in here, which I thought was interesting, was the changes to the public sector activity, particularly in regulation.
Definitely. So we are seeing increasing numbers when we measure pages of regulation that companies are facing, and this is a phenomenon that's happening globally. Mm-hmm. We're also seeing coordinated action between countries. So the OECD clampdown on tax avoidance was a great example of that. Mm-hmm. So quite often people say that they think that ESG issues are so far into the future, or they'll never actually hit earnings or balance sheets. And actually, we are starting to see that happen.
Yeah, that was one of the things, and I'll ask you later about how you sort of coordinate all those long and short-term impacts into an investment thesis, but we'll get to that in one moment. I wonder, one of the things that I found really interesting was the possibility that was floated of the bailing out or the getting out of bankruptcy of P&G after the fires in California, the possibility of them being taken out by some large pension plans. And as those pension plans already have ESG agenda, the P&G would be ultimately beholden to them basically now. Doesn't have to wait for legislation. Do you think that is the type of thing that, even if it's just, I realize it's just a proposal right now, but is that the type of thing that's quickening the pace of these changes?
Definitely. So we are seeing a number of asset owners really, becoming signatories to the PRI, right. So advocating principles of responsibility, that's happening globally. We're also seeing greater legislation, even sometimes requiring these asset owners to think about these longer term issues. Mm-hmm. So in the UK, which is our home market, all of the pension funds need to talk about how they're integrating ESG, considering long-term climate change. And we know actually Canadian asset owners are also very focused on these. And of course, they're some of the biggest buyers of some of these real infrastructure assets. So I think even in the private markets, you can start to see a lot more scrutiny on this. And actually, again, a lot of these investors have been doing this for a long time because they're aware of the illiquidity of these assets. Mm-hmm. So they're quite focused on these issues as well.
Yeah, one of the things that always stuck out to me about some of the Canadian provincial pension plans doing this is that some of them have very substantial oil and gas employment in their regions, and they were still going, yep, we're Xing that out. So it's fascinating to me to see how that has changed. Now let's move on to your model, because I have rarely seen so thorough a mapping of the ways that companies can impact society, and rarer still, mapping of the positive and the negatives. Usually you just see the negatives. I didn't see the positives. So could you tell us a little bit about how you got to there, what you all were thinking when you got there?
I'd love to. And, one of the central theses that was behind this was the idea in 22 years of investing, I'd yet to meet a company that was either wholly good or wholly bad.
Right.
And this was a way of thinking about how do we both capture the positive things, and even the worst company in the world is providing employment opportunities, and that is a positive for society. And so what we did is we went to academic research. Mm-hmm. And we looked for studies. We found about over 400 of them that quantified the impacts that companies' activities were having on society. So a great example is we maybe found a study about what the cost of alcohol abuse was in a single country, what the impact on GDP was. And then we used GDP scalars to get a global number. Mm-hmm. We found 400 studies covering about just less than 50 different impacts. Mm-hmm. And then that was good because obviously we would have a range of studies for each impact. We could take out the more extreme versions and come up with a reasonable number, for the cost to society. So what's great about it is it's a framework as well. And that means that as we start to get new impacts that we're all aware of, we can start putting them in. So we've got online gambling addiction in there. We've got social media.
Right.
And I think that's a really important part of it because actually our views or our understanding of externalities are constantly evolving.
Right. And some of the unintended consequences of those regulatory things are also, evolving as well. And that actually leads me to dig into the data a little bit. I wonder how you handle the companies that don't report carbon emissions. There's a substantial number of them.
Definitely. So we cover 9,000 companies in this, and we're trying to get a good global perspective. So obviously that includes quite a lot of estimating with a slight sort of penalty because they're not disclosing for them, when we definitely want to encourage people who are disclosing. But the great thing is because we are looking across so many different factors and we're balancing them, not just on environmental issues, but on social impacts as well, you get a much more balanced view of a company's impact, which is very helpful.
So if I understand that correctly, essentially the lack of transparency around carbon comes out in the wash.
I mean, carbon is a significant issue, but it's just one issue. Right. And we can make a reasonable number of assumptions to, based on sector performances and averages to get there. And that's really important that we, as I said, we get that view because we want to use this and understand the impacts of entire markets and sectors. And that's one of the most powerful ways that we can use this tool.
Okay. And then I was also curious about how you incorporate what is sometimes a slow, but also sometimes a fast-changing regulatory market, if you include the impact of case law, not just the rules that are made by governments.
That's a great question. And one of the things that we do with the 47 different impacts is we don't say when they're going to hit. Mm-hmm. We wanted it to be a really clear framework based on the academic research and almost to step away from these ideas of judgment. But very broadly, we found that there are over $6 of negative externalities for every $100 of sales across the world. And what I think is even more interesting is when you think what that means on a profitability. In a worst case scenario, you could almost have half of global profitability wiped out.
Right.
Now, that's not going to happen overnight, but at the margin, it does feel like the headwinds are going to start impacting.
Right, and that will push companies to make decisions about that. And I guess the other thing I'm curious about is how you then take all of this great data and these insights and move them into the analytical work that you do on a day-to-day basis. Where does the rubber hit the road?
Yeah, that's a great question. So one of the things that enables us to do it is because we've converted everything to a dollar value. I think the first thing is that pretty bluntly, we're speaking a language that the analysts understand.
Right.
And we're just measuring exposures. But we find that really helpful, and we're using it in a number of ways. So we actually have a quantitative equity process that uses this as an additional factor.
Okay.
And there are some really interesting variations, even within sectors. And by stock selection within the sectors and adding that onto the other factors that they're looking at, they've managed to substantially reduce their exposure to negative externalities.
Okay.
So that's one use. Another use, which is really helpful, is a sense check. And we have a lot of fundamental analysts, and it's really helpful that we have this picture of what are the externalities that the company is facing, and have they captured all of that in their work?
Okay.
Because of course we all know that there's huge potential for confirmation bias, and sometimes we don't see the future problems that might be in our favorite stock that we're looking at.
Right.
So that's really powerful. And then also finally, it enables us to do some really interesting portfolio analysis.
Yeah.
So as well as getting this overall value of, and we can compare it to a benchmark, so you can see, does your portfolio generate or have more exposures to externalities than the benchmark? Really important to put into context. And does that broadly make sense? But we can also break it down. So for example, maybe your portfolio doesn't look so great on the environmental things, but they're doing a great job on the social. That would come through for some of their employment practices where they're paying more than living wages, would be a great one, or some of their R&D and their innovation. So it really enables us to get much more granular as well.
So does that come in, that part of the analytics come in on the stock selection or on the asset allocation or somewhere in between?
So flexible, so it can be both. So it's great because a sector analyst can use it on that individual stock, and then we can aggregate it up for a portfolio because we have it for 9,000 companies. So that's one of the great things about it, is how it can be used in so many different ways.
So if you were to basically let this wag the entire asset allocation dog, how much of a change would that be from a sort of more standard 60-40 type of portfolio?
That's a great question. And again, one of the things that is really important to help people understand about this is you can scale it up and down as much as you want. So as I mentioned, in our quantitative process, we're still using it in the way of our overall risk parameters. It's still a very diversified portfolio. This is the type of portfolio that's still used in a defined contribution pension plan, typically. So they've managed to substantially reduce the negative impacts without kind of going crazy on, the active share or the risks that they're taking. But yes, if you absolutely wanted to, you could be identifying the companies with the most positive impacts and just have a concentrated portfolio on that. And I think that's something that's really important in how we're designing all of these tools, and I know you talked about the tail wagging the dog, but ideally they can be used to complement existing investment processes that we know will generate alpha and add this additional, we're really familiar with sort of risk and return trade-offs,
right, and
it's adding this additional sustainability trade-off as well.
Okay.
But it's sustainability based on financial factors, so it sits really well in that.
Great. When you, so many of the people who are listening to this podcast are responsible both for the asset management and also for the client management, for speaking with clients about this. Do you find that this is quite germane to their thought process? And what types of stopping points do they get to when you're talking about this?
Yeah. So one of the real shifts that I've noticed when speaking to clients is they're all fed up of us telling them how great our ESG processes are and our fundamental research processes are. And they are really longing for us to show me what it means.
Yeah.
And I think what's great is that this does show it. I think what's also really good is it moves the debate on from values to value.
Right.
So actually, interestingly enough, tobacco and alcohol stocks don't come out brilliantly. Unsurprisingly, there are a lot of negative things around tobacco that we are seeing captured. But you can be a lot more focused on that, and you can make a decision on, that type, whether or not those headwinds are discounted or not. Similarly, on the environment, you can have a much richer conversation because we're including some data on water and other emissions besides carbon emissions. So we find that the initial feedback has been really positive. And one of the best ways that a colleague has of describing it, it's a way of showing how what our clients are reading about on their front page, sugar tax coming to New York City, and seeing how that relates to the financial pages. Because in my investment experience, these things are real.
Right.
Governments have to deal with the changing companies have to deal with changing governments, changing policy environments. So to think that you can just distill, companies, they don't exist in isolation.
Right. Okay, so this all sounds great, but everyone in analytical land is always looking for what could go wrong. So what could go wrong?
So one of the things I think you have to be really aware of this is it's just measuring exposures. It's not measuring how well you are managing those exposures.
Okay.
So, for example, diversity is one of the negative externalities that hits companies. What we're not capturing is those companies that have then put in place great policies to improve the diversity of their workforce. Or again, emissions come out as another negative externality, and we're not capturing what companies are doing about that. So it's really great for telling part of the story, but that doesn't mean that you kind of disengage your brain and don't talk to the companies and then don't understand how they're really responding to these real business challenges. So I think it's most powerful when when those types of insights are also layered over it.
Okay, so I think this is an interesting next step because everything started out with leaving things out of portfolios. And now some of the bigger asset owners are actually taking a more proactive working with the company owner phases. And this works nicely in it from the asset manager side. What's next in your mind? I mean, you all have been looking at this for a long time. What do you think is next in the great escape here?
So one of the things which is really interesting about this is that we can then start to actually try to measure the impact. So, if we are having those conversations with companies and getting them to improve their health and safety performance, have fewer industrial accidents, then over time, we should see the portfolio improve and there to be, using this tool that we have, SustainX, the externalities will reduce. And I think that will be really powerful. And it also goes back to, we all can understand our purpose in generating investment returns. And that's one of the reasons why I love this job. It's very clear.
Right.
But I also think we are also stewards of companies and we need to make sure that they are generating those returns in a responsible way. And, where we see fatal flaws in companies' business models, pointing them out. And this will see if we are actually managing to get them to progress in a really tangible way.
I hope you enjoyed our podcast. If you have not yet, please subscribe at the podcast app of your choice. Also, please visit us on the web at cfany.org.